Hi, I'm Jimmy. In this video, I'm going to walk through some simple steps to help us get a better idea if a stock's dividend is safe. Going through these steps will help us protect our money and give us the best chance of increasing the amount of passive income that we can bring in from stock dividends without doing too much extra work. Okay, let's jump right in. So there are 5 things we can look for when we first start researching a company that pays a dividend that will tell us if there's a good likelihood that the company's dividend is safe. Now I'm going to use the company AbbVie, ticker symbol ABBV, as our primary example to help us demonstrate our research process behind determining how safe a stock's dividend is. Okay, so here are the key numbers we want to watch for to see if a company's dividend is safe. And personally, I like doing them in this order because I think it paints the picture nicely for us and leads us as to the best direction for us to research next. But feel free to mix them up if you think there's a better way of doing it. The first one to look at is the dividend coverage ratio. Now, to calculate the dividend coverage ratio, we simply take the earnings per share and we divide that by the dividends per share. The higher this number is, the better off we are. Now, if we reverse this formula, well, the new formula gives us the dividend payout ratio. And obviously, we're going to want this one to be as low as possible. But for our purposes, you can use either one, whichever one you think is easiest, whichever one makes the most sense to you. They really tell us the same story, just an opposite, one where you want high, the other one you want low. So that's step one. Can the company afford to pay their dividend? Now, one thing that we have to be careful about is putting too much power in any one number. For example, if a single quarter, perhaps they didn't cover their dividend in that quarter, or even in a single year, if they didn't cover that dividend, well, that doesn't necessarily mean that the dividend isn't safe. They could have the cash to cover it. There might have been some reason why their earnings dropped that particular year. But if the dividend coverage ratio is consistently low, well, that probably means that over the long run, the dividend isn't going to be too safe. So that's a great place to start for the first one. So next, we want to look at the dividend growth rate. To get the dividend growth rate, we simply calculate how much the dividend changes from one year to the next. To illustrate this is a chart of AbbVie's dividend going over the past few years. Now we can see that they didn't start paying a dividend until 2013, and we may notice that last year they had a pretty big jump in their dividend, although they did have a dip in their dividend from 2013 heading into 2014. Now this gives us an idea of the overall growth that AbbVie has experienced from a dividend perspective. Hopefully this could give us an idea of what we could expect from their dividends in the future. Now, where I find this interesting is I actually think that this is more useful if we jump to the next item on our safe dividend checklist. So right around the same time, I would look at these two numbers together, number 2 and number 3 on this checklist. Number 3 is the growth rate of earnings or profits per share. So for this, we do a very similar thing. And the first thing we may notice for AbbVie is that they've done a great job of consistently growing their profit per share or earnings per share, you might hear it called EPS for short. Now we can see that their 2016 earnings per share were 42% larger than the 2015 earnings. Now, if I were researching this company, I would question what happened in that year. Maybe they made an acquisition that year, or did they really just do a good job of growing their core business? Or perhaps they did a stock buyback, and that's ultimately what made their earnings per share look a lot larger. Now, some investors don't really like stock buybacks, and there can certainly be questions as to how good a stock buyback is, depending on how they fund it or how often they do it, or what do they pay for their own company. If they overpay, it's probably not a good thing. But for dividend investors, it's not necessarily a bad thing. After all, if a company buys back shares, well, they no longer have to pay dividends to those shares that they bought back. So that would mean that, in theory, they could make their overall dividend payment cheaper, assuming that they keep the per share dividend amount the same. Well, in my mind, that's probably makes it more likely that the company will increase their per share dividend, since it could cost them, in theory, it could cost them the same amount spread among less shares. So to existing shareholders like you or I, well, that could increase our per share dividend and therefore increase our own passive income. Okay, that being said, we may still ask, that's interesting and all, but how do we tell if the dividend is safe? And for that, I think it makes sense if we combine this chart and our previous chart. This is the new chart we get. And with this chart, we can now compare the dividend per share and the earnings per share. Now, just looking quickly at this, well, we can see that earnings per share seems to be, if we're just eyeballing it, it seems that earnings per share is growing at a faster rate than dividends per share. And that's exactly what we want. But if we want to do some quick math, well, it may make sense to calculate the compounded annual average growth rate, which turns out that earnings per share is growing at slightly more than 19% from 2013 to 2018. Dividends per share grew by slightly less than 15%. So 19% versus 15%, that's a good thing for us. Now, this is one of the most important parts to finding a safe dividend, because if what we want is for their dividend to be at least the same, ideally we want it to increase, well then we want to know that the company is going to increase earnings per share at a faster pace than they're going to increase dividends per share. Because when earnings falls, as they inevitably will at some point, well, we don't want our dividend per share to be threatened by a temporary dip in profits. So I think it makes sense to look for dividend stocks that sort of have a buffer zone, sort of like this is for AbbVie. Now, we may ask the question, is earnings per share the only number that we should compare dividends per share to? Sure, earnings per share is one of the easiest numbers to get. It's one of the most popular numbers, but it's not necessarily the only number we should use. So next on our safe dividend checklist is to check free cash flow per share. Now, with free cash flow per share, we may notice that it's a bit more volatile in AbbVie's example here. And that's actually one of the reasons that I think it's important to check both earnings per share and free cash flow per share if you can get it. And I think it's important to check these two versus dividends to see if the company has at least enough earnings and free cash flow to keep up with their dividends, although we may have to expect a bit more volatility in the free cash flow number, which is not necessarily a bad thing. It's just, if we were to switch over to AbbVie versus free cash flow, well, we can see that free cash flow it continues to cover it, which is a good thing for the safety of this particular dividend. Okay, now before we move on to the fifth point on the checklist, I just want to bring out one interesting thing. For AbbVie, we calculated that the dividend per share growth rate, the compounded annual dividend per share growth rate of the past few years was 15%. Now, no company is going to maintain a 15% growth rate in dividends or earnings indefinitely. It's simply too fast. So it's important to realize what we're looking for is the sustainability of their current dividend level, not necessarily the pace of which they're growing. To do that, we're going to have to come up with a much more reasonable growth rate, which is frankly going to be below 5%. My guess, 2, 3, 4%, we could probably make the case for. But I just want to bring that out, that what we're looking for is the consistency of the company's ability to cover the dividend, not necessarily, they're going to grow by 15% every year. We're going to have to watch this one closely to see what they're really going to grow by as they get bigger and bigger. Okay, now we move on to the fifth ratio for identifying safe dividends. And this one is the very popular price to earnings ratio. Now, with price to earnings, clearly we're not directly referring to the sustainability of the company's dividends, since dividends aren't even used to calculate the price to earnings ratio. But with this one, what we're trying to do is we're trying to account for the effectiveness of the total return of each of our investments. So the concept here is that we don't want to overpay for a stock. If we buy a stock that has a very high price to earnings ratio relative to, let's say, the market or the industry or even the company's own history, well, even if we were to go through all of the other items on this safe dividend checklist and let's imagine that we determine that it seems that this particular stock's dividend seems safe. Well, even if it is, if we pay too much for the stock, even if this dividend stays the same, it's likely that the stock price will eventually get repriced in line with where it should be, in line with whatever the benchmark is, and that could cost us potential total returns, and there's simply no reason for us to get involved in something like that. Now, the price to earnings ratio isn't the only way for us to come up with the fair value of the stock. In fact, my personal favorite is not to use price to earnings. I like using discounted cash flow. So we could do that very same thing that would essentially take the place of price to earnings. Ideally, what we don't want is to overpay based on our calculation of what the fair value of the stock is. So if we look at the sustainability of the dividend and then we make sure that we don't pay more than our calculation of fair value, I'm guessing we're going to do quite well in the long run as dividend investors. Now, if you're not 100% sure of how to calculate the implied fair value of a stock with the discounted cash flow method, well, I actually did a fairly thorough walkthrough of how to calculate that and where to get that information, how to calculate it, how to apply it. So that could be a great next video to watch if you're interested in that type of thing. Besides that, thank you so much for sticking with me all the way to the end of the video. I hope you found this interesting. Don't forget, hit the like, subscribe button. Thank you, and I'll see you in the next video.